and welcome back to another episode of the Econ Bits podcast. This semester, the three of us are taking part in the macro workshop in preparation for the Fed Challenge in the fall. In this class, we are diving deeper into the main indicators of the macroeconomy, including GDP, inflation, unemployment, and many more. Today, we will be discussing all things to do with GDP, but first, let's do some introductions.
Hi everybody, I'm Robbie. I'm a junior at Stack and I major in accounting with a minor in finance, and I'm also a member of the baseball team here.
What's up guys, I'm Ryan. I'm a sophomore here at Stack and I'm also on the baseball team, and I'm a finance major with an economics minor.
Hi, I'm Jem. I'm a senior here at Stack. I'm a business management major with an economics minor, and I'm on the women's tennis team. Okay, let's get started. Robbie, over to you.
So GDP, it's an overall measure of the economy, of the economic well-being of a country. So it's important to look at GDP and its growth throughout the time of on an economic basis. GDP is a very good tool to look at for policy analysis because it's a quick and fairly direct measure to see if a new economic policy turns out to be useful. If the GDP goes up from a new policy, then it can be a successful policy, and the contrary is true if the GDP goes down.
In order to calculate GDP, there are 4 factors that are needed. These 4 factors being consumption, investment, government spending, and net exports. All of these components play a key part in determining an economy's GDP. Consumption refers to the consumer spending on goods and services in an economy. Investment refers to the spending on capital goods such as machinery, commercial real estate, or business equipment. Next, government spending includes spending on infrastructure, education, healthcare, and anything else that the government chooses to purchase. Lastly, net exports is the difference between an economy's exports and imports. The largest factor of GDP in the United States is consumption, and it's not close. Consumption makes up around $19 trillion of the current GDP in the U.S.
Understanding GDP is definitely a beneficial skill for people to know. For example, when real GDP is growing, businesses within this economy will likely hire more staff, meaning there will be better employment, and this will then increase the circular flow of income scale. If there is better employment, this will lead to a better standard of living within the country because of more people being able to afford goods and services. There are 3 ways to measure GDP: the output method, income method, and the expenditure method. The output method, which is used in the UK and not commonly known in the US, is when you add all of the value added along the production line. The income method adds together all income generated throughout the process. The expenditure method includes all spending within the economy. There is also nominal and real GDP. The difference between the two is that real GDP is adjusted according to inflation within the economy, whereas nominal is not. Nominal GDP equals real GDP times the GDP deflator. Real GDP equals nominal GDP divided by the GDP deflator. You can also use the chain-weighted method, which uses average prices of goods to measure growth between 2 years. In a speech that Senator Robert F. Kennedy gave when he was running for president in 1968, he said the following about GDP. It does not allow for the health of our children, the quality of our education, or the joy of their play. It does not include the beauty of our poetry or the strength of our marriages, the intelligence of our public debate, or the integrity of our public officials. It measures neither our courage, nor our wisdom, nor our devotion to our country. It measures everything, in short, except that which makes life worthwhile. It can tell us everything about America except why we are proud that we are Americans. Although GDP is a good measure of economic performance, it doesn't really measure these factors Kennedy is talking about. Do you guys agree?
Yeah, Jem, I completely agree with what Senator Kennedy said there. That's why I think that the Gini coefficient is actually a great measure of the health of the economy. Although it doesn't measure the overall economic well-being of a country, it's a measure of economic inequality in a country. Basically, a number closer to 100 represents greater inequality in wealth. And wealth inequality, by the way, is a disparity between the high earners and the low earners in a country. In the U.S., the Gini coefficient grew consistently in the late 1900s, but since 2020 seems to have plateaued and has actually dipped below 40 for the first time in quite some years.
I totally agree with you guys that we should look at a different coefficient besides GDP to see about the well-being of the economy. Another one of these measurements that we could use to figure out the well-being in an economy is the Human Development Index. This index measures the development of a nation based on three key factors. The first factor is health, which is measured by a country's life expectancy. Second is education, which is quantified by the expected years of schooling for a child, and then the average years of schooling for an adult. Lastly is the standard of living, which is measured by gross national income, which represents the amount of income going into an economy. I believe that this is a good measure to look at along with GDP because this index gives a better look at the well-being of people in an economy.
Thanks, guys. Those are two really good measures. I also found the Better Life Index. So the Better Life Index is designed to let you visualize and compare some of the key factors like education, housing, environment, and so on that contribute to the well-being in OECD countries. These definitely measured the factors that Kennedy was talking about, but GDP is definitely the best indicator for the monetary value of a country's final goods and services.
Completely agree with you on that one, Jem. Recently, I actually read an article that I wanted to share with you guys. The article has to do with big government spending the country has been seeing. Investor Paul Tudor Jones says that the big government spending will soon hit the stock market negatively, and the U.S. has been spending a lot of money over the past year, and the interest rates have soared. The economy is quote-unquote on steroids, according to Jones, due to the government spending. Jones shows fear about this as he says that the big government spending is unsustainable and the bubble will soon pop. If the bubble does pop like he predicts, the economy can go into a major recession, which we have been successfully avoiding for the last few years now. What's your guys' thoughts on this article?
Yeah, I definitely agree that this is unsustainable as a long-term solution for the economy. So it'll be interesting to see what their next moves are in order to compensate for the current level of spending. Also, it's natural for economies to experience recessions and booms as long as those recessions don't last too long amount of a time. Thanks for sharing.
I also agree with Robbie. The fact that all of this spending is unsustainable. I believe that there will be some sort of action to try and reduce the amount of spending from the government. I just hope that this action comes before the pop. If the economy does pop, I'm also interested to see what this will look like for the United States. And I also found an interesting article on how the Federal Reserve may act based on the data that is soon to be released. According to the article published by CNBC, the United States Treasury yield has been slightly down recently. This falling yield has caused a caution in the markets. This will end up increasing bond prices. This, along with the Consumer Price Index, Producer Price Index, and other key data for January soon to be released, have investors waiting to hear from the Fed. Many experts believe that the Fed could be cutting interest rates soon. Jem, what do you think about this?
Thanks for sharing that with us, Ryan. I actually found an article in the US News that gives us a glimpse into the 2024 economy. Attention shifts to evaluating the strengths of the economy at the year end and its prospects for 2024. The government's impending release of its first estimate of fourth quarter GDP on Thursday is anticipated to show growth of around 2%, though some economists wouldn't be surprised if the figure passed this, considering the 4.9% pace of the third quarter of 2023. Christopher Rupke, chief economist at FWD Bonds, suggests that the boost in consumer spending at year-end will likely extend into the first quarter of the new year, indicating that the economy may not slow down as much initially predicted. This optimism, coupled with expectations of a potential soft landing for inflation, prompts economists to reconsider recession forecasts for the year. Additionally, Friday's release of the Personal Consumption Expenditures Price Index, closely monitored by the Federal Reserve, is expected to reveal a core rate of 0.2% for the month and 3% annually, reflecting the ongoing trend towards the central bank's 2% annual inflation target. How do you guys feel about this?
So far, it seems like the Federal Reserve has done a great job at avoiding a recession, which seemed inevitable just a few months ago. The economy's continued to surprise us and trend upwards, which is great. High consumer spending is always a great indicator of a healthy and growing economy. Seeing the trend back down towards a 2% inflation is also great, as it could relieve some stress from consumers, as interest rates have been incredibly high over the past year and a half. Ryan, what are your thoughts on Jem's article?
I actually think that the Federal Reserve is going to reduce interest rates. This will allow for more consumer spending, as Robbie said. I think that this will be a good idea in the long run as it increases economic activity, thus increasing GDP. I think that many people will be upset if the Fed decides to not cut interest rates, and there will be much debate in the upcoming weeks. I'm interested to see what January's data is going to look like compared to the previous months.
Okay, that's everything we have. Thank you for listening to our podcast about GDP. Thank you.
Thank you.